Hello everyone and welcome to another video with the Silvertail Property Group, and in today's video we're going to be releasing and giving you guys a rundown on the Port Adelaide project called Atelier down in Port Adelaide in Clare Street. So as you can see on the screen, this is the exact location of where this project is currently located. Now, the exciting thing about Port Adelaide is that there's a lot of activity going on, and there's a lot of good news stories coming out all over the place, in the media, in the papers, on the news, and there's just a general excitement going on about the area because it's one of those places that's got a lot of history. There's been a lot of gentrification happening. There's a lot of the old going out and then the new coming in, and what that does is it presents really good opportunities for people who are looking to invest or even move into the area, because obviously getting in at ground zero is always going to be a benefit, especially for the investors wanting to take advantage of the future growth that happens in the area. So without further ado, I'll jump straight in. Now, in this video, I will be talking a little bit about the area, some of the exciting stuff that's happening, and I'll also be running the numbers. So if you're an investor looking at putting some money to make it work for you, I will be going through the numbers in a lot more detail. So one of the key fundamentals for us when we invest is we always look at properties that are close to either the water or close to the city. And in this case, Port Adelaide is obviously close to the water, and it's its own city in a way. There's obviously been a lot of history there over the years. Port Adelaide has been a hub for South Australia for as long as we've known, and what that does is obviously there's a lot of potential there for people who want to capitalize on the history and the story of what Port Adelaide has to offer. In more recent times, we've had news coming out around big investments going on in the area, particularly the $60 billion investment that's happening into the submarine project around Port Adelaide. And what that means is there's a lot of money that's coming through that economy, filtering through to all the workers and the people nearby. There's obviously a big government push as well to incentivize business owners to start opening businesses down that side of town. And what that means is there's going to be a lot more building, construction, and gentrification happening all across the board. So as you can see, there's the Adelaide CBD, and you've got Semaphore Beach. So in the property investment world, this falls within the Golden Triangle for South Australia. So the Golden Triangle is anywhere between Adelaide City all the way up to Outer Harbour and down as south as Seacliff. So that region there has a lot of opportunities for us. Now, in particular with Port Adelaide, and in particular with this project here being Atelier on Clare Street. So if you're coming down Grand Junction Road and you turn right onto Commercial Road, that first street on the left, which is Gracechurch Street, there's currently a big warehouse which has been recently knocked down, and the site's been cleared and getting ready for stage one of this big project. So there's going to be 67 townhouses in total. At the moment, we're only starting with the first stage, which only has about 15 to 20 that they're building out, and then as they release further stages, the pricing will go up comparatively. So when we look at Clare Street in comparison to the major infrastructure around, it's about 200 meters from the Port Adelaide station. It's about 250 meters from the Port Adelaide Canal Shopping Centre. It's a couple hundred meters away from the waterway, and we've also it's a 1 kilometre from the Port Dock and 3 kilometres to Semaphore Beach. So in terms of location, it ticks a lot of the boxes for us, because the major things that we look out for are things like transport, amenities, shops, schools, hospitals, and just existing infrastructure in the area, and Port Adelaide definitely ticks all of those boxes. Now, in terms of the project itself, as I mentioned, the project's called Atelier. It's named after a French artist, and that's going to be reflected also within the design of some of the properties and the floor plans in there. So as you can see in this plan here, This is the first stage that we're looking at the moment, which is on the corner of Grace Church Street and College Street, which is right across from the park. And what that means is we're starting with probably the most desirable part, and obviously whoever gets in first is going to reap the benefits of that particular spot. Now, in terms of the pricing on these properties, they start at $359,000, and that is a full turnkey and fixed price build. So that means it's ready to move into. Most builders generally show you a cheap base price and they add everything on afterwards, and you have to spend another $40,000 to $50,000 to complete the properties. In this case, this is all turnkey, all done. That includes things like your landscaping, your fencing, your driveways, your pathways, your appliances, your air conditioning, and it's fully completed, which means you can get the key from the builder and either hand it over to a tenant and they can start living there straight away, or you can move in and move your furniture and it's ready to live in. Now, the $359,000 townhouses are 2 bedrooms and 2 bathrooms with an open plan living area and a balcony. So I'll start with the downstairs level. As you can see from the front entrance, you got the entry with the stairways leading out from the side. There is a little study nook under the stairs that could be used for a small desk and a computer. Then you've got a French style laundry. As you walk through, you've got a door that goes into the garage, and across that there's a main bathroom which has a double-sized shower, the basin and a toilet. As you go through, you've got bedroom 2, which is downstairs, and that leads out onto a little courtyard, and it's got built-in robes down there as well. Now, if we go upstairs, as you can see, you come into the open plan living area, which has got your kitchen, your living and your dining space. There is a generous sized balcony which either overlooks the park or the street, depending on the orientation. And then you've got the main bedroom at the back of the property, at the back, with also a built-in robe, and it's got an ensuite with, again, a generous sized shower and the toilet and basin. And then there's a linen cupboard on the outside. So in total, there's about 112 square meters of home. The land size is roughly about 100 square meters, and these are done at a turnkey level as well. So they are Torrens titled, which means that there's no shared facilities or shared services between the neighbors. These are independently owned and can be independently built and will be independently built. And the way they're structured is as a house and land package, meaning that you only settle on the land portion and you only pay stamp duty on the land portion, and then the building is paid in progress payments. So every time the builder completes a stage, you pay them for that stage and they move on to the next. So we do have a lot more information, obviously, that we will pass on by request. So if you want information or floor plans or further specification list, let us know and we can get that over to you guys. Now, what I wanted to do was go through the numbers. And the numbers is really what makes the bulk of the decision making for us, whether we take a project on or not. And what I want to do is start with just plugging in the property details. So I'm going to use lot 13 as an example, and that's lot 13 in Clare Street in Port Adelaide. So I'll do this whilst we are doing this video. So I'm doing this all live, and as mentioned, it's a townhouse property. It's got 2 bedrooms, it's got 2 bathrooms and a single car garage, all under the main roof. Now, the strategy that we're going to be using for this example is a buy and hold. So obviously there's different strategies when you come to invest. With these particular properties, they suit a buy and hold strategy because they're in high growth areas, the yields on them are quite good, and the tax depreciation benefits are also quite good as well. So it ticks the 3 boxes that we look at. So I'm going to use the $359,000 properties as an example. Now there are different designs. There are 3 bedroom with 2 living areas. There's 3 bedrooms and rumpus rooms. There's 2 bedrooms and a study. There's different designs, but for this example, I'm going to use the 2 bedroom, 2 bathroom as the example. In terms of our due diligence costs, we always allow $350 for due diligence for our building inspection. They are brand new properties, so we won't need a pest inspection, but we definitely recommend having a building inspection because any building defects that we can't pick up on, the building inspector will, and we can get that back to the builder and they can make good on any defects that we need. Now, in terms of the settlement costs, I'm going to assume and work on a 10% deposit. Now, the deposit can vary from person to person. Some people do this with a 5% deposit, some do it with a 20% deposit. We've even got clients that have done this with a 1 or a 2% deposit, depending on the lending options that we have. So in this case, I'm going to use a 10% deposit, which is pretty much the average across the board, and that works out to be $35,900. Now, in terms of the stamp duty, the stamp duty is worked out on the land portion alone. Now, with the land portion, I'm going to jump into the calculator here for the stamp duty, and I'm going to put $100,000 on the land value. It's a residential property. It's not a foreign purchaser, and it's not an off the plan. So we're looking at about $2,830. I'm going to plug in $3,000 for stamp duty here. So we've got $3,000 for stamp duty. Now, your legal fees will consist of your conveyancing costs. So that is usually between $500 to $800. In this example, I'm going to allow $1,000. So roughly you're going to need about $40,000 in total to be able to settle on this property in terms of your settlement costs. Now, when we look over on the loan costs, our first one is the setup fees for the loan. Now, that can be $0 or it can be up to $400 if you're going for a package with a lender. So in this example, I'm going to allow $400 just to be on the safe side. And the next part is the LMI, which is the lender's mortgage insurance. So if you are borrowing 90%, or if you're borrowing anything over 80% of the value of the property, the bank will take out insurance to make sure they protect themselves in case you default, but they'll charge you that fee. So they can add it onto the loan, which is basically capitalized, and in this case it works out to be just over $5,000. There won't be any valuation fees or any other loan costs at this stage, so we'll keep those blank. Now, when we look over on the third section, which is the improvement and selling costs, because this is a brand new property, there's no improvement costs that we have to really factor in. So we're not doing any renovations or any improvements to the property, so we can keep those blank. However, the bottom part, being the selling costs, it factors in the costs of transacting on the way out. So if we decided to sell, we would generally allow 2.2% for an agent's selling commission, and that is worked out in our selling costs if we need to sell up at any stage. Now, from a rental point of view, we have rental estimates on these properties for the 2-bedroom coming in at $350 to $370 per week. So I'm going to take the lower end, being $350, and I'm also going to allow 2 weeks vacancy for these properties. Now, I'm just on my other screen at the moment, so bear with me while I just confirm some numbers here. Now, the second section is the property expenses. So this is made up of rates. Now, rates is calculated on land value. So on a land value for a townhouse, you're obviously looking at a lot less than a house with, say, a 600 or 700 square meter block of land. But in this case, I'm going to allow $1,000 a year for your council rates. Your land tax is obviously dependent on your situation and how many properties you currently own, but in this example, I'm assuming that this is going to be either a first home or a first investment, or maybe investment number 2 or 3, so our land tax exposure is going to be very, very minimal, but in this case, we're working on 0. Now, for building, what we would do is we would actually put in building and landlord insurance. So for building and landlord insurance, you're looking at roughly about $50 to $60 a month. So I'm going to allow $700 a year for building and landlord. Your body corporate is not applicable because this is a Torrens titled property. There's no shared services, there's no body corporate, there's no strata, there's no sinking fund or anything of that nature. Repairs and maintenance are also minimal because it's a brand new property, and generally, maintenance items are looked after by the builder. There's no cleaning contracts, there's no service contracts, there's no garden and lawn maintenance. Your letting fee is going to be dependent on which property manager that you use. I'm going to take an average for 1 week's rent being $350, and your property management, I'm going to allow up to 8% for property management fees. Now, if we look over on this third section, being the loan loan and interest component. So in this example, I'm going to use the interest only loan type just to show you the raw numbers. We can produce one with principal and interest. However, if you want something that's a bit more specific or tailor-made to your financial situation, then please let us know and we're more than happy to produce something like that for you. Now, the loan terms, we're going to work on 30 years. That seems to be the average with most of our clients. And if we're borrowing 90%, that means we're borrowing $323,000 for a $359,000 purchase, which makes our loan to value ratio 90%. Now, the next section down is our interest rate. Now, for those of you following what's happening with the Reserve Bank and their interest rates, we're actually at all-time historic lows. I'm currently working with lenders that are getting us anywhere in the low threes for interest rates. So it can be anywhere from 3.1 to 3.5 on an investment, and this is as of today being the 4th of October. However, that will most likely change and probably go down over the coming 3 to 6 months, especially from now till the end of the financial year. But for this example, I'm going to be extra conservative and I'm going to work on 4% interest rate. So we know that we'll obviously get it a lot cheaper, but 4% will be conservative. The next bit over is going to look at our tax and market factors. So the major components for us from a tax effectiveness point of view is going to be depreciation. And because this is a brand new building, as the property starts to get used and lived in, then all the items in there start depreciating on paper. So what that means is things like carpets and curtains and appliances and blinds and all those kind of things will depreciate in value because they're not brand new after someone starts using them. Now, that depreciation is not a physical cash cost to you, but what it does mean is because it's going down in value on paper, you get to write that off your tax. So I'm going to give you an average example, and in this case, in the first year we can expect about $10,000. In the second year, you can expect about $9,500, and it'll go down in small increments all the way through. So we'll go down to 8, then 7.5, 7, 6.5, and it'll usually bottom out at about $6,000 a year. So I'm just going to keep the example going in $500 increments though. Now, the next part over is your market factors. Now, there's two parts to this. The first one is the CPI, which is a consumer price index that basically says every year costs are going up by about 3%. So we'll leave that 3% in there. The second part to it is the annual or the average capital growth. Now, with most properties, we would generally work on CPI plus 1 or 2% if we're being conservative. In an area like Port Adelaide, we would work on CPI plus 2%. So we're working on a 5% capital growth. Now, to put it in perspective, the property market in South Australia, being one of the slowest moving or slowest growing states in the country, we've averaged 7.8% over the last 100 years. So, we're being pretty conservative here. They say property tends to double every 7 to 10 years. In this example, you'll see that it won't even double, but we still have to allow for a bit of capital growth. Now, the third section over is the taxable income. Now, this is where it differs from situation to situation. And, obviously, if you're earning $150,000 a year, you're going to be paying a lot more tax than someone who's earning $40,000 a year. So in this example, I'm going to take an average wage of $85,000 a year. So someone who's paying 37 cents in the dollar on their tax rate. And we'll show you what that looks like once it filters through. So when we look at the scenario report, this is what it means to us. In the top section, you'll see the capital growth. So we're purchasing this property at $359,000, and over a 10-year period, this property is growing to approximately $584,000. So this tells us that we can expect about $220,000 worth of growth over a 10-year period. So if we were to average that out, that's an extra $22,000 a year that we're adding to our bottom line and our net position. So my question to all of my clients is, what what would you have to do to make an extra 20 grand a year? You know, how many hours would you need to work? How much extra would you have to save? What would you need to do? The beauty about property is that the capital growth happens organically without you even doing anything about it. It's one of those, one of the easiest ways to make money while you sleep, basically, because what you're doing is you're owning an asset that's growing in value whilst at the same time producing an income for you. And I'll show you how that looks like in a moment. Now, in this example, we're working on a 90% LVR. And as you can see, the loan amount, because we've done this as an interest-only example, the loan amount doesn't actually change. So it remains $323,000 the whole way through. And the expectation out of this property is that if you owned it for 10 years and it's worth $584 and you still owe $323, you're still going to have $261,000 worth of equity that you would either cash out, or you'd be able to draw out a portion of that. You wouldn't be able to draw out all of it if you were to refinance, but certainly gives you more options in 10 years time than had you not had the property in the first place. So that's the loan and equity side of it. The next bit down is the rental income. Now, with this particular property, we're expecting $17,500 in rental income per year. Now, this translates to a 4.9% gross yield and a 3.9% net yield. So what that actually means is there's $17,500 in income that you're adding to your bottom line as well. The next bit over is the annual expenses. So as mentioned, we're working on a 4% interest rate. Now, obviously, we can get that down and that interest component will be cheaper. But in this example, we're working on just under $13,000 worth of interest. And our property expenses is just under $3,500 a year. So all in all, it means that we've got $16,374 in total expenses. However, we've got $17,500 in rental income. So what this tells us is this property is going to be positive cash flow even before tax by about $1,100 a year, which is $22 a week. So again, this ticks the second box for us, meaning that we are getting the capital growth and then now we're getting a positive cash flow before tax. Now, the third bit, which is probably our favorite part, is what happens after tax, because remember, this person who's earning $85,000 is paying 37 cents in every dollar in tax. So they're paying a bit of tax. But because they have this property which now has $10,000 worth of depreciation, they're no longer getting tax on $85,000. They're now getting tax on $75,000 because we got 10 grand worth of depreciation. And if they were taxed at 75 instead of 85, that means that they would have an estimated tax refund of just under 3.5 grand. So that $3,482 plus the $1,126 means now this property is positive cash flow by $4,608 per year, which is another $90 per week. So let's recap. We're getting a property that's growing by about $22,000 a year in capital growth. Before tax, it's making us $22 a week, so it's actually making us money instead of costing us money. And then more importantly is after tax, it's now positive cash flow by $4,600 a year. Now, if you've got your own home loan and you're trying to pay that down, that $4,600 is obviously going to make a nice little dent in bringing down your mortgage. But not just that. The beauty about it is that every year after, that cash flow amount goes up. So it's helping us to create a passive stream of income that we're not having to work for. So, the old saying, 9 out of 10 millionaires make and park their money through property. Well, this is a prime example of how property does that, because you see, most people are conditioned to, work harder to make more money or work more hours or go get another job. Whereas the rich people know that it's not about selling your time for money and working for money. It's about making money work for you. And the way we do that as property investors is we find assets that do three things. They grow in value, they give you an income, and they help you save on tax. And in this example, this ticks those three boxes for us. So this is definitely a property that we would recommend. Now, as I mentioned before, this example here is taking in a few assumptions that you're earning $85,000 a year. It's assuming that you got a 10% deposit. It's assuming that you're getting a 4% interest rate. So obviously that will change depending on your situation. What we would recommend is you actually come in and meet with one of us. We can go through this in a lot more detail and give you a specific forecast that's around your situation as well. So if you would like to do that, we're going to include a link at the end of this video. So click on the link and register for a phone call. The phone call will take about 20 to 30 minutes. It'll be more of an exploration type phone call where we'll identify what you're trying to do, what your goals are, what your starting point is, and then help you put that map or that strategy in place to help you achieve that. So I hope you guys got some value out of the video. If you got any questions, please feel free to reach out. Otherwise, we look forward to catching up soon, and yeah, all the best. Talk to you soon.